New Talking Point. Today, I'm your host, Neeraj Shah. The Talking Point today are the views of Anand Shah, Head of PMS and AF Investments at ICICI Prudential AMC. It's been a while that we've spoken to him. So, Anand, great having you. Thanks for joining in.
Thank you for having me.
So, Anand, what are the signposts currently telling you? Because we're seeing a bit of a cool off in commodities, which everybody seems to be latching onto for a risk on. At the same time, it doesn't seem like we are out of the woods. So, a bit of pull and pressures there. How are you navigating through this?
No, I think if I were to step back a little bit and look at a little longer term perspective, I think overall the earnings recovery has been very strong, and especially during the last 2 years, that should have been very difficult for India Inc. Actually, the earnings growth is very strong. So that is one part which is which was missing. If you see prior to January 2020 or December 2019, we had almost 5 years of negligible earnings growth rate for one reason or other. We had asset quality review, you had demon, you had GST, you had NBFC crisis, so on and so forth. But I think that's a good news for markets. More near term, I think it's more of an flows issue. It's not the fundamentals issue. If you ask me, even through this crisis, India has navigated well. While the inflation is high for India too, but it's a bigger problem, especially in Europe and to some extent in US than it's in India. And to that extent, I'm not overtly worried about the inflation issue. And as you rightly said, the coordinated response from central bankers and government globally is taking off some pressure from the commodity prices.
Yeah. So, Anand, do you view that as a constructive trend, or is it too volatile to say the least, simply because the Russia-Ukraine conflict is still on and we still have supply chain snarls from China, I presume, because the COVID situation out there and their handling of that situation is very, very choppy to say the least. So, is this a trend building up in commodities that they peak, now they are going off, or is it difficult to say that right now?
No, I think you have to also see that while the central bankers and the government in Western world are sort of trying to slow down their economy. Yes, the China is a big element with their zero COVID policy, and it's one of the largest consumer of metals, particularly for metals. And if you see, metals has really fallen off. Oil is yet to start falling off, so it's still elevated. So yes, you're right, China is important. That should be counter-cyclical. So we are hoping that in next 3 to 4 months, the big Congress is also will be behind us as far as China is concerned. They should be able to kickstart their economies. So from now to next 3 months, they just don't want to make any mistakes till you have their elections behind them. And to that extent, my take is it would be more counter-cyclical. It will support commodities from falling further at a point, especially if there were to be a recession in the US. So there's a lot of talk of recession, which can then take the commodities further lower. There, I'm very clear that we'll have counterweight from China kickstarting their economy. So to that extent, the metal prices and the commodity prices will fall, but they'll remain elevated from the previous decade, the low prices we have seen.
So, Anand, in which case, what's the trigger for the markets from where we are right now? It could be negative or a positive, but is it the resolution of the conflict? Is it China starting to support the economy and therefore some bit of global growth returning? Could it be that earnings falter in India as well? Because there's a high probability of that happening as the quarters scale by, or is it something else? Is it inflation or a recession? What have you? So what are the key triggers you're watching out for?
Yeah, so I think, as I said before, not too perturbed on the Indian earnings growth rate. There we have levers. There we have levers from manufacturing. We have levers from, formalization of economy. So I see a lot of reason for earnings to remain resilient.
Okay,
that's not worry. I think as far as triggers are concerned, there are twin triggers. One, obviously, inflation coming off. If there is some sort of a thaw, especially in crude price and gas, the energy prices have been a pain. And that's if that comes to some sort of a resolution between Europe and Russia, that there is some sort of a thought there. That's one. The second one is obviously the big reasons for the markets under pressure globally and in India is also the US 10-year going up and the money moving from equities to fixed income. So I think that's the other trigger we are watching very closely. Whether we are seeing end of dollar appreciation, we are seeing the 10-year yields on US peaking out, which will be again is a reflection of what the Fed is thinking. So we are getting, obviously Fed will continue to hike for a while, but we're already seeing murmurs of, say early 2023, second half 2023, we might have a reversal of this tightening. So then the money starts flowing back into the emerging markets. That would also be a one trigger for equity markets in general, globally and locally. So these are the two triggers. China opening up also helps overall sentiments, but also it cools down the manufacturing inflation because China is a factory for the world. And this is also causing some sort of supply chain issues. So that will also cool down the inflation a bit. So on the fundamental side, China opening up and Russia-Ukraine thaw can help. On the technical side, the US, if we are seeing end of the tightening cycle in next 6 months, that will also take some pressure off the emerging markets.
So, and what would the portfolio strategy be in such a case? Because, broadly, are you preparing or prepping up your portfolio for what might happen in 2023? Or is it more geared towards here and now because forecasting the future in these times might be slightly unpredictable?
I think we are seeing a significant shift that we are seeing into the markets. Look, and I'm taking a little longer term view. As I said, the near-term issues are near-term issues. There will not be issues in 6 months' time. There will be new issues. I'm not saying the issues are going every 6 months we'll have new issues, but structurally, if you see, last decade, 1.5 decades, you were better off being a P2C company because China would produce anything and everything that you want, from safety pin to boiler, from the most commodity tires and rubber chemicals and basic any chemicals, everything you will get it cheap from China. So China was exporting deflation to the world, good for Indian consumers, good for Indian B2C businesses because the input costs were benign, but very bad news for manufacturer of the same stuff in India or anywhere in the world. So the manufacturing ex-China struggled. Now China could do this successfully because of multiple reasons. They had a cheap electricity, cheap energy prices, a lot of coal mining that was going on there. They had cheap manpower. They had relaxed, pollution norms, which are getting tightened since 2014. And last but not the least, extreme government support for manufacturing. All those four things are slowly and steadily unwinding over the last few years, but more recently we have seen, they're clamping down on thermal-based power plant has a wide range because the energy prices are going up for the first time. Net, we have been seeing shift of commodity manufacturing from China to Vietnam and the other Southeast Asian countries. I think India is warming up to that, not only commodity manufacturing, but also value-added manufacturing through PLI. And one other important one is banking. So there are the two areas where we are seeing long-term structural re-rating possibly, both manufacturing, mining, as well as banking. Banking also, if you see since 2015-16, post the AQR, they've been providing for the NPAs in infra, in manufacturing. Then you had NBFC crisis, then the real estate slowdown. Then you had COVID wave 1 and COVID wave 2. So there has been each segment of the banking where it has lent, there were issues after issues after issues. They have provided, and despite of providing for those, one-off issues, the banking segment has done well. My take is next few years, you will get recoveries from those. At the same time, we'll have a benign environment for the new entities. So we generally like banking. It's been a big underperformer for a few years because of the reasons I said. And also manufacturing after a long time we are seeing. So these are the two areas where we've been more overweight And actually, we are underweight consumer-facing businesses.
So I was about to ask you, if you circa take it back to say 2018 and a portfolio there, the proportion of B2B versus B2C, and current, the proportion of B2B versus B2C, what's the deviation?
Yeah, that's why I'm saying that if we had...
No, so what's the percentage allocation? I'm trying to understand that. Yeah.
Yeah. So if I'll give you an, more of a ballpark number. If you were 70% B2C and 30% on B2C or a B2B, today it would be other way around. So
Wow.
my take is that's the shift we are looking at. B2C, while they will continue to do well, and that would be a supportive to the overall earnings growth rate. My take is a far lower earnings growth rate than the previous decade and a far higher PE multiples. Both works against the B2C.
Got it. Yeah. So Anand, interesting. And actually very, very interesting points. Just a follow up there. So all through the last decade, everybody used to say, right, that the Gora or the foreign guy doesn't come to India for the fabulous manufacturing. They come to it for the large consumer base. Now, because of this whole China plus one, plus the fact that Indian manufacturing is now started to getting proven resilient, you reckon the reverse could happen in that the foreign business could come to India not only for the consumers, but also for the manufacturing prowess, also because they want an alternate to China. Is that the theory playing out?
I think you have to appreciate the investors come to any business for its earnings growth rate and for its return on equity. I mean, if I were to simplify completely. And I remember pharmaceuticals way back in 2003 was at 10p, the domestic pharmaceutical. That time MNCs used to be. And the foreigners came and bought them once they demonstrated that they have science skills, they have ability to compete in the US generics market and also win there. So those businesses moved from 10p to 30p. Those businesses got bought by foreigners also. So secondly, if you were to ask of specialty chemicals, that's another sector. I've seen trading at 5 to 10 PE multiples. And once India started gaining its right to win from MNCs and others, they started getting orders, and then they could demonstrate that they can reinvest capital at a sustainable high ROE, ROC, then they got multiples. So now the specialty chemicals trade at a premium to the pharmaceutical. Actually, pharmaceutical is more complex chemistry than specialty chemicals, but nevertheless. So my point is that once you can deliver sustainable high return on equities on the incremental capex also, and we have seen some of the examples like cement. It's manufacturing, but it's got not only FI allocation, it's got multiples also. Select metal companies have got where they have not. So part of the issues in the manufacturing in the past also had been capital allocation mistakes. So hopefully now we don't have too much of greenfield capex. Normally greenfield capex comes with a lot of risks, delays, cost overruns, and 3 to 4 years of no profits, no cash flow generation. Now, if you hear and you see, it's mostly brownfield capex. The greenfield capex is far and few. So the risks are also reducing in manufacturing. Most of the companies we meet, they don't want to take too much debt. They want to do capex from internal accruals. So we are also seeing a sea change in how the manufacturing segments or manufacturing companies are behaving than what they used to do in 2006, 7, 8 when they felt like they need to hurry. Today,
but aren't we seeing greenfield capex, for example, in select pharmaceuticals, in the whole of the specialty chemical space? Everybody's announcing fairly large greenfield capex as well, right?
Yeah, but the large greenfield capexes which needs land, which need acquisition, that should delays. Those are not the case. These are very small, and many of them are continuing to do adjacent land and same same chemistry. When I say greenfield, means entering new into the business.
Got it.
Again, the specialty chemicals also sticking to the chemistry they understand.
Of course.
They are not entering into new areas which is fraught with risk. That is key observation. The steel guys are doing steel capex. The cement guys are doing cement capex. I hope not many overseas acquisition, which is again a territory which has not worked very well for manufacturers.
That's true. That's true. Anand, so quick couple of follow-ups. One, a conversation with a few people who look at a lot of past cycles, right? And one or two of those guests, when asked about whether we will see new companies having this ruling this decade. So the examples given were that in 1990s we saw the birth of IT, pharmaceuticals, and to an extent chemicals. And when asked about whether this new decade will see a completely new set of sectors, I think there's a lot of talk around how we might see a continuation of what pharma and chemicals have done, and after a bit of lull, what IT can do when it comes to Indian companies exporting to the world phenomenon. What's your sense? Could it be a new set of themes, or could these which have consolidated their positions as world leaders, so to say, in their niches, actually come out and do much better in the decade to come?
No, so both would work. I have no doubt that there will be areas like some of the examples in the unlisted space we have, where even in capital goods, which is rare, even in capital goods, we have been able to export a plastic molding machine in Europe. It's unheard of that we generally get machinery from Europe into India, but we are getting some entrepreneurs who are able to sell their machinery into the Africa, into Europe and other places. So there's no doubt that we will have new areas also where we will have right to win. But this traditional space is ready. So for the China Plus One in particular, you spoke about, I think there we are seeing already the MNC manufacturing are already looking up. So it's not of future, it's already existing. They're seeing what are the products which they can move to India and can get more. Part of that is also end of cycle. So many of the global MNCs are looking forward to EVs and investment in those areas. They want a backup for their ICE manufacturing, the ICE engine manufacturing. So some of that looks like, they are giving away the old technologies nevertheless, but that also, if we can prove ourselves that we can do ICE machinery well, there's no doubt that tomorrow, if we are cost competitive, we'll get the next technology also. So yes, the new areas we can do manufacturing exports, but the old areas where we already know, we already have skill set, the China Plus One will work.
Got it. And lastly, when I was looking at some of the portfolio positions, I don't want to get into specific names, but I'm just trying to understand. For the longest time, we've seen promise, for example, in themes like telecom, hasn't quite translated into material gains from a shareholder's perspective, right? And there's this conversation for the last 3 years now that India is a consolidated market, ARPUs will move up, and earnings growth will be very, very robust in a large market like India. Somehow we're not seeing evidence of that actually coming through. What gives here?
I think a very big parameter which we keep on looking for is something called consolidation in the industry. So if you see, for many, many years, we have only seen new entrants coming in. From 2006 onwards, we have seen new players coming into the market. The real consolidation where actually the weak or the unviable businesses have exited despite of, and they have not made money, but they stayed in the market. It's the first time that so many players have sort of vacated the space. And now we are really looking at 3 players, 3 plus minus players in each of the circles. So I think that's good. Secondly, coming to the point, I think we have seen pricing power in last 2 years, not significant. Obviously, we are still today the cheapest market in the world as far as data is concerned, but nevertheless, it's been a 40% rise in the average realization for the telcos over the last 2 years. So that's substantial from the times we have seen since the pricing is only one way to go, which is down. And that's also reflecting not significantly, but slowly and steadily reflecting in improving cash flows for the businesses in general. Having said that, I agree with you that the return on equities are not great even today at this pricing for all the players. And to that extent, I think we will see over time the pricing has to inch up and move up, given that we consume a lot of data. So even at such a low price, at such a low ARPU, we would consume significantly higher data per customer, per telecom consumer, than what even the developed world will consume. So I think Yes, there is a promise, and there is a consolidation also in the industry. We are continuously watching that space and looking forward to evaluating these businesses on the ongoing basis.
Last question, and $1 million one. It's intriguing everybody, and that is the positioning on information technology. World leaders, proven beaters, going through maybe a temporary lull. Is it prudent to stay away, or is it prudent to build positions, considering that the valuations are the most lucrative in the last maybe 48 months, or maybe 24 months, not 48 months really?
Yeah, I think so. It was a combination. It was a combination of over optimism in the sector, where people thought that this is not stopping, and the weak numbers that you will see in coming quarters, this quarter and coming quarters. Two things are happening. One, as the economy opens up, or rather during the lockdown, the corporates had not so many expenditures around travel, around office and all that. They had no choice but to invest into IT. Now, next 2 years, they will have to invest into non-IT space of the business also, be it office space, be it travel, tourism, conferences and so on and so forth. Similarly, for the IT companies also, there was a phase when were not spending on visa, you're not spending on travel. So you could, and you're not even spending on office expenses, everybody was working from home. Now that's changing. And to that extent, there will be a year or two when there will be some readjustment in terms of growth. Unfortunately, at the beginning of this phase, we are sitting at a very high valuations. So luckily, the valuations have already coming off. We'll have to live through these 2 to 3 quarters of negative surprises on earnings, and that's when, so rightly said, these are the world-class companies. They have high standards of corporate governance, and to that extent, they will always be part of the portfolio. It's about timing rather than whether to own them or.
Lovely answer. Thanks, Anand. This was lovely talking to you today. A lot of insights. So thank you so much for them, and wishing you a great week ahead.
Thank you, Neeraj, for having me once again.
The pleasure was ours, and viewers, thanks for tuning in.